Hi, I'm Eric Kazatsky, Head of Municipal Strategy here at Bloomberg Intelligence.
And I'm Karen Altamirano, Senior Associate with Municipal Strategy.
So, welcome to the latest in a series of weekly videos where we take a look at what's going on in the municipal market. And believe me, the last week has given us a lot to talk about with the rise in rates and obviously the impact of treasuries bleeding into the muni market. Now, when we ask my clients what our feelings are, how higher rates are impacting the muni market, the easy answer is just to take a look at how it's impacted total returns for the year. Now, through the first 9 months of this year, muni returns had been positive, although they had been getting a little bit lower. What has happened over the last month is that muni returns have flipped negative, obviously with the big backup in rates. Now, what's interesting, and to give us some historical context, is that if muni rates finish the year also in the red, it would be the first time of back-to-back losses since 1980, 1981 period. Now, obviously, we're not trying to break a three-peat record or anything. And what I think is giving clients a little bit of a silver lining is that even following that 1980, 1981 period of double losses, there was a huge return to positive total return in 1982. So we're hoping that we're going to follow that historical pattern if we indeed finish off this year in the red. Now, aside from rates, I think there are absolutely some definitive undercurrents that are also being impacted by the rise in rates. And over the next couple of minutes, we'll take a look at a few of those.
Yeah, so I would say like one of those would be the decline in liquidity, the liquidity crunch we've been speaking about a lot recently. I would say take a look at the level, just as one example, take a look at the level of the broker-dealer inventory in their balance sheet that's committed to tax exempt. We've seen that decline in recent years. Also, the bank losses from fixed income holdings has dissuaded a return to pre-pandemic inventory levels.
Yeah, absolutely. That's a very good point. And we actually saw some regional banks, start to teeter on the edge, throughout early spring and into the summer just because of those fixed income losses. But I think clients should also note about when it comes to less liquidity in our spaces, it's not only the lack of absolute liquidity going on with broker dealers right now, it's the lack of how many broker dealers are actually participating in the muni space. So the MSRB, Municipal Securities Rulemaking Board, does a great job of putting out stats on how many dealers are in our space. And it's something that we include in our shifting marketplace report each and every January. That's located on BI Muni Go for those who have terminal subscriptions. And so what's happened over the last, say, 10 years has been an increase in the cost of regulation and spreads being compressed within our space. It's just led a lot of firms to sort of exit the business or just commit capital to more profitable places elsewhere. And that's really been sort of a headwind for our space in this year.
Yeah, I think other areas where we're seeing this is leverage structures are being impacted, and that's due to the cost of leverage being much higher. Our data is showing a decline in tender option bond structures, which are something that's unique to our market. And they've declined both in issuance in 2023. We're seeing a decline in creations. Specifically, if you look at the last 5 to 6 months or so, you've seen that decline. And on the other end, what you're seeing is the volume of existing TOB unwinds that has been rising.
It's not only the cost of leverage there with the structures, it's also the funds that are, using, I would say, an above average amount of leverage that are actually feeling the most pain. It's interesting when we looked at sort of levered returns for ETF products, and two we can name specifically, XMPT and RTAI in the beginning of the pandemic when rates were at their absolute lows. It was interesting how well they performed and how much they outperformed the general market. Now, obviously, if rates have backed up several hundred basis points, they have underperforming the market by a magnitude of standard deviations. And we obviously at this point in the cycle think that that pain is going to continue as long as leverage costs stay as high as they are. So in summation, we think that what's going on right now in the marketplace is normal in a rising rate environment. And we would advise clients to sort of, at least stay the course and understand that if you don't have to sell, you're not booking that loss. And also to understand that in periods of rising rates that are led by a Fed tightening cycle, munis have and continue to outperform other alternatives. And we're hoping that's the case going forward. So thanks for joining us.